The non-institutional market, which really dominates this space, is really almost the Wild West right now.
Welcome to the Significance of Wealth podcast, where we explore the evolving landscape of wealth management, private investments, and collecting as both a passion and investment strategy. And now, here's your host, Tom Ruggie.
So today I have with me Michael Grayson, effectively known as Grayson to myself and many others. We actually utilize Mike's firm to set up our Destiny Alternative Fund, which is now about a little bit over 4 years old. And more recently, over the last 2 to 3 years, we've been doing an awful lot of direct investments with Mike and his firm. So we're going to talk a lot about those today and get Grayson's insight and directionally where things may be going in his opinion and whatnot. So Grayson, happy to have you here. Thanks for joining.
Yeah, I really appreciate it, Tom. I feel like this is long overdue, so I'm happy to be on and looking forward to the conversation today.
Awesome. So we have been investing in quite a number of mid to late pre-IPO companies. I mean, just in 2025, we've invested in Anthropic, Anduril, SpaceX, XAI, Databricks, Crusoe, Stripe, and Agility Robotics, all of which I would put into that somewhat later stage. I feel like once we get through this cycle, if you will, that it may revert back to more smaller mid-sized companies. Would you agree with that? Or do you think once we get through this technology cycle that there's going to be other up and coming late IPO stage type companies?
Yeah, I definitely think it'll be situational based on capital market environment. So our IPO markets open or closed. Right now, we think, and we talk about this almost every day together, how we're at this really unique inflection point where you have these generational potential companies like a SpaceX or an OpenAI or an Anthropic or a Databricks that have been around for a while. Like a lot of these companies have been around for 10 years. We had a tough market environment coming out of 2021 and 2022, where we've had almost no IPO activity now for 3 straight years. And finally, it seems like IPO markets are reopening. And a lot of these businesses have some AI component to them, but there are really some generational opportunity sets in these underlying businesses where it seems like we're at this kind of perfect storm of having access to pre-IPO companies still relatively early in the game, but we're going to see a lot of IPO activity, I would hope, over the next 12 to 36 months in this universe. Once a handful of these companies or more actually go public and are now accessible in public markets. What that means is we'll continue to evolve the program, potentially a little bit more into mid-stage companies. I do think there will always be private businesses that are on the kind of brink of IPO where we'll continue to focus, partially because at least the way I think, and I think I speak for both of us, our partnership capital really thinks about mid-late stage being the sweet spot where there's enough juice to squeeze on these investments to make upside return, but we're not taking binary risk of early venture investing. That's how we want to invest our own capital.
No, we definitely have the same thought process. And ironically, one thing that I've been quoted as saying many times is I believe that we're in a once in a generation moment right now, specifically, not just with the investments that we've made, because there's other great companies that are out there that we have not brought to the table for our clients. And there's been 1 or 2 that we talked about bringing to the table, like CoreWeave, that we missed the boat on. Nonetheless, the reason we didn't do CoreWeave was because we brought Anduril to the table. So you have to take a trade-off here and there, but it is, again, in my opinion, just an amazing opportunity set that we're in right now. And I'm also in agreement that the next 12 to 24 months is going to be a very exciting time for a lot of the names that we've brought to the table. Can you talk to me a little bit about your vetting process? And when I say your, First Trust, Vivaldi, et cetera.
Happy to. There's really 2 layers of the diligence process. So the first I'll talk about is like a little bit more market oriented, where we don't believe collectively this is a do-it-yourself marketplace. Like there are institutional players in this market, which we would pride ourselves on being one of those counterparties that are providing really high quality solutions to high net worth and family office clients. Best execution on price, reasonable fee schedules, appropriate structuring of these investments where you actually control the asset and safeguard client assets that way through structuring. You invest alignment, so investing your own partnership capital alongside the client's post-close support. So like making sure you're providing regular updates to the end investors, like those are all things that an institutional firm is going to provide an end client. That's paramount to the outcome of the investment. These are non-investment thesis related items. So like before we even get into thesis, it's making sure like we're executing like institutionally. You have large brokerage platforms running around with supply in these companies. And when I say these companies, like we'll talk about the businesses we're focused on, but think about like a SpaceX or an OpenAI or an Anthropic or an XAI or a Databricks. Like these are names and companies in Anduril Industries. We've done a number of Anduril transactions. Businesses you might know, like they're on CNBC, Wall Street Journal, 60 Minutes. There are brokers all over the marketplace, independent at kind of the large brokerage platforms that are like preying on retail investors. And then there's a bunch of suspicious counterparties also that are basically masquerading as venture firms. Anytime you get a market like this where there's a really, as Tom noted, a once in a lifetime potentially or generational opportunity set, like it's going to introduce a lot of shady counterparties to the marketplace that you need to be careful with. The brokers intermediate trades, connect buyers and sellers. There's double-digit percentage commissions in this market. So like think about a real estate. These transactions are almost like real estate. Directly negotiated between a buyer and a seller. There's a broker in the middle of the trade. In the venture market that we're talking about, in the high demanded names, those are double-digit commissions the brokers make on both sides of the trade. So like you're paying a broker substantial upfront fees. There's no alignment because they're not putting their capital into it. It's a very transactional relationship. So you get no post-close updates on how the investment's performing. So you're pretty much shut out and in the dark immediately after you close.
In this conversation, are you including purchasing these investments directly in the secondary market?
The secondary market is, I'm referencing the secondary market, but the brokered secondary market.
Gotcha.
Like we've done secondary transactions where we've bought shares from a shareholder of the company through a directly negotiated secondary, but we were able to drive terms in that transaction. For instance, an example is the Reddit deal that we did together in late 2023. We bought shares from 3X employees pre-IPO. That was a directly negotiated secondary. We knew those 3X employees needed liquidity. They'd departed the business. They'd lost touch with kind of the progress of the company. A lot of times they're motivated to sell. Like they had tax liabilities, specifically these three individuals that they had to meet. So they needed to raise liquidity and we were able to negotiate. We entered that one at $29 per share. That was a $5 billion market cap on the company. The stock's trading north of $200 per share right now. So there are certain secondaries where you can situationally get great access and execution, like the Reddit trade that I just walked through that has a great outcome for investors, but that's because we were collectively driving the terms institutionally. The market I was referencing is really the Wild West secondary marketplace where a broker gets their hands on SpaceX shares and they're marking them up and there's egregious fees in the middle of it. That's most of the secondary marketplace, I would say, carries that negative connotation where it's really aimed at exploiting demand in these names and potentially to the detriment of retail investors. So that's two sides of the marketplace. You need to make sure if you're interested in these names that the counterparty you're engaging with, whether it's First Trust or Destiny, is institutional. So we pride ourselves there. Secondly, we spend a lot of time obviously underwriting the individual companies, understanding the business models, understanding the IPO visibility of the company, understanding kind of the unit economics and competitive moat that the company has, and then just all the KPIs. So like the full financial model, having access to that under NDA from these companies so that we can really understand financial performance and projections for the companies, having information rights where we have access to financials. That's how we not only underwrite the business, but also keep the investors up to speed on the investment post-close, whereas brokers don't have any access to that information. And so you're really making an investment, just frankly hoping the company IPOs and you have a monetization event for the business.
So I know there's been several situations where we were talking about gaining access to a company, and after some due diligence, we ultimately decided not to move forward. Can you, without naming the company or companies, but can you give some examples of a situation where there was a pretty deep dive done, but ultimately the team said, hey, we're not going to do this?
Yeah. And this is where the alignment comment I made is so important. Like if your counterparty that you're working with is investing their own capital meaningfully, they have skin in the game. So they're not incentivized. We're not incentivized, and both of our firms have meaningful skin in the game, and personally, on both sides of this conversation, to make sure these are institutional quality and like best execution deals. Conversely, brokers are all transaction focused, so they just want to get the trade closed. A couple deals we passed on for diligence purposes that are completely separate. We looked at a robotics company they just raised a large financing round at a 10 billion valuations. We did 8 different calls with the CFO and CEO, vetting the business. We were under NDA, had full access to the data room, financial projections. We understood other participants in the round as well. So we were talking through kind of reference checks to other private equity firms that were potentially participating along the way. Ultimately flew out to Palo Alto to meet the management team, do an on-site. Before we invest, we're always doing an on-site, physically in person. Like we need an investment team and operational due diligence team in the office, physically in person before we're committing our own capital and client capital.
Yeah, which is
Frankly,
a great point to make also.
Yeah, it's frequent travel. Like we're all over the place, domestically, Western Europe. Like you really need to be there on site because the software was lackluster for this robotics company specifically. Like the demo and autonomous mode on the robot didn't work. And we had heard that from other counterparties that were also betting the transaction. They were like, look, the hardware, aka the robot, the humanoid robot itself is really interesting. Like the software needs some work. And so we went in with kind of moderate expectations, but the reality is like they just weren't there on the software model. And the valuation was hard to get comfortable with at 10 billion as well. We were working through like a lot of kind of concerns around the valuation front. So that's where we did 8 different calls over a couple months, documented all these notes into 100 pages of write-up on the business, soup to nuts, flew out 5 individuals to Palo Alto to vet the business, and like ultimately like decided not to proceed with the transaction in the red zone. Another deal that we passed on for totally separate reasons is Anthropic. So we did the E round in March, as you noted. Then they did the Series F a couple months ago. We had access through a venture firm. The round got very competitive. So like the company was like basically like restricting all these different groups from participating in the round. They were 5 times oversubscribed with demand. They had the ability to really get tight on the round. And so it got hard to get access to the Series F round, particularly. We had one venture firm that was going to provide us access through their SPV. On paper, this was a very blue chip venture firm. 8.5 billion in assets, large institutional limited partners, like clients, investors. On paper, you would see nothing problematic with this firm. When we actually went in and were in their offices physically, as I noted, whether it's a business like this robotics company or it's a venture firm or a counterparty that's intermediating the deal for us, we need to be physically in their offices, show me the stock certificate to make sure proof of existence of shares exists. Oh, I don't want to see the PDF stock certificate. I want to see the electronic stock certificate because we see forged PDF stock certs all the time. Talk to me about your valuation and kind of audit process. I need a side letter that says you're going to give me the shares in an IPO and not liquidate me out and give me cash. Couldn't get there with them on those items, like immediate non-starters for us. We were very incentivized from an investment standpoint to get the deal done. Like we've been collectively bullish on the business now
Oh, yeah.
for a while.
That
And we
was a
want
difficult pill to swallow, but for the right reason for our clients.
right.
Yeah.
Protecting client assets, our own capital as well. We're aligned. We would never, this is a 5-minute explanation that can basically be summed up in we would never risk a penny of investor capital if there's anything operationally or structurally that we can't get comfortable with, even if it's our best idea, like an Anthropic investment where we very much want to participate from the investment side of the table. And so this is really puts, I think, our partnership into an echelon that most groups are not there. And we take the diligence soup to nuts on not only the investment side, but candidly, like even more on these deals on the operational side, incredibly seriously, because there are a lot of problematic structures, fee structures, counterparties in the marketplace where there's going to be over the next couple of years probably some pretty difficult outcomes for family office clients, not because they got the investment thesis wrong, simply because like they've been wronged by the counterparty that they partnered with. You just need to be very careful in this marketplace transacting.
Switching gears a little bit, you mentioned this, you bounced around this a little bit earlier, but what do you see happening in the niche that we've been investing in over the last couple of years? What do you see happening over the course of the next 12 or 24 months? Again, just your crystal ball. Obviously, nobody knows. And not only does nobody know, but things can pivot and change at the drop of a dime for whatever reason, government reasons, economic reasons, whatever. But what's your thought process at this point?
Yeah, I think a decent amount of exit activity, specifically IPOs for these businesses. So I'll talk IPOs first. 2026, there are a number of juggernaut IPO candidates for next year. The most hot off the press is SpaceX, where we've done numerous transactions in SpaceX together through the company run tenders. Databricks is another one that we've been really active in together. We did 2 financing rounds earlier this year. The company's grown 60% top line. They're profitable now as of this year. And so the free cash flow profitability puts them in a good spot for IPO. The business we just recently invested in, Crusoe, which is an AI infrastructure data center developer. They're the firm that's doing the Stargate project in Texas with Oracle and OpenAI, huge data center development project. Crusoe will make $2.3 billion of earnout revenue on that project. Also an IPO candidate, strong IPO candidate. For next year, one thing we do when IPOs happen, specific to our partnership, is distribute the stock to end investors in the IPO. So the clients get in-kind distributions of the stock. It's good for 2 reasons. One, if the investors want to hold the position post-IPO, when the stock's public, they can. 2, it doesn't create a tax liability either. So we really focus on providing in-kind distributions of the stock after the IPO lockup expires. That's one dynamic. The only other thing, and I'll be way more brief on the subject, is the private markets are getting much more liquid to the benefit of investors. So there's no market exchange for trading these companies. However, there's a ton of secondary market activity. There's also these companies are running tenders now regularly for shareholders to liquidate their positions potentially once or twice a year formally. And so even if IPOs languish, the market has progressed to the benefit of shareholders where there's better exit optionality in private markets outside of just a binary IPO outcome. And so both of those dynamics, I think we're really excited about. We've been collectively heavily deploying capital over the last 3 years coming out of 2022, where we had a big reset in this universe and a lot of these companies were formed. And now I think we're going to actually start seeing some real monetization events for these companies over the next 24 months.
Yeah, I would agree with you. That's my personal thoughts as well. And as private companies have been staying private companies much longer for a number of reasons, but I think we're in agreement that the market's becoming pretty hot for some of these longer tenured private companies to consider options such as an IPO or something like that. And then again, it's all a cycle. So things will probably cool off at some point later down the road. And if my crystal ball works, it's probably 2 to 3 years. And then private companies may stay private longer again. But again, I think the market is really strong for this sort of thing at this point.
It is. It is. And you need IPO markets in this space. We've made investments 6 or 7 years ago where you go in, you're like, I love this business. I don't know how I'm going to exit it. This is really attractive. And a lot of times that's not a good strategy. Like certain managers will tell you that. They'll be like, look, think about this as being like super long term. We don't know how we're going to monetize the position. Like, we don't need the liquidity. Like, this is the investment merits, like, are hard to argue with. But you really you need pretty clear exit strategy outside of, we could sell this through a secondary or tender out of this. And so when IPO markets start reopening, like it seems like they are this year and especially into next year with a number of these candidates, that tends to be the best time to deploy because like realizations are not super easy to come by in pre-IPO investing. And so that gets us really excited heading into 26.
From your vantage point, are you seeing where big pools of capital are flowing into these investments? Obviously they're flowing in, but is it coming from sovereigns getting involved in this, endowments getting involved? Obviously the ultra high net worth is clamoring for accessibility to these types of investments, but it's also become, as we know and we've experienced firsthand, that accessibility has really been tightening up over the last year too.
That's correct. Yeah, both true. Tons of capital coming into these companies. When they get a little bit, the sovereigns are coming in now. So to your point, like there's a ton of balance sheet behind those entities and demand that comes alongside it. Also the mutual fund companies are getting involved. So
Yeah, that's true.
and they get involved closer to IPO. Like they don't want to do the business when it's 7 years out, but they want to cross over the stock to their public side. So like when they start getting a little bit later stage, you'll see like big firms like Fidelity and Franklin and T. Rowe. And this is something I touched on with the First Trust kind of part of the story, where the companies really like those crossover investors on the cap table when they get closer to IPO because they know they'll be supportive of the stock after the IPO, but it brings a lot of demand. Like those are large entities who write big checks. So a lot of these rounds are tough to get access to, like the Anthropic rounds and the OpenAI rounds. You need $200 million just to play in those rounds. Like the minimum check sizes on those rounds are generally 200 recently. And then they're raising $10 billion because these are CapEx intensive businesses and there's 40 billion of demand for the round. Like the numbers are really hard to frankly wrap your head around a little bit. Like 40 billion of demand in the Anthropic round, and you've 3 guys at Anthropic that are running the book on the round. Like things get challenging to get the transaction closed if you're on the buy side. Like what they start doing is getting extremely restrictive. Groups get cut back, allocations get cut, so it can lead to prorations where you thought you were going to get $20 million in the round and you're only now getting $10 million in the round. So it's a tough, very competitive marketplace, as you'd expect, for these businesses where they have transformational or generational potential. I think that's where collectively we've had a lot of success. A lot of the marketplace that's out marketing these companies are not actually closing the transactions because these rounds are meaningfully oversubscribed. So I'm proud of the fact that we got one Anduril deal in the ground last year that's looking like really attractive cost basis. We participated in the Anthropic round. Databricks was a tough round to get access to. We closed on that transaction. XAI, we did a really attractive secondary, and the company's raising capital this month at a large valuation increase from where we bought the stock. And so to be able to actually not only go out and source and diligence the investments, but actually just take it through closure and execute for the clients has, I think, been something that puts us in kind of the top decile or top quartile of this space.
Well, time will tell on the positions that we're doing. One thing that I always tell our clients is you have to invest in any one of these deals with the mindset that you could lose 100% of your investment. And so that's why I preach diversification. And yet at the same time, I'm so bullish on everything that we've been doing. And that's that to me is why I really consider it that once in a generation opportunity. I feel like this is the pre-internet boom stage where we're getting access to the real companies that are going to be, when all the dust settles, some of the top companies out there, when there's going to be a lot of Me Too companies that come along and frankly probably take a lot of people's money that is not able to execute and puts those investors at risk of losing all their money. But yeah, it's been just such a unique opportunity. Now, just a couple of the things before we close out. You've mentioned a couple of times us being insiders on the positions and the 6-month holding period. With, again, nobody knows the answer to this, but I would enjoy your insight on just, you could use SpaceX, or you could not use any company as an example. By the time the IPO goes through and we as insiders, including our clients, need to hold it for an additional 6 months. And then the benefit of a First Trust and Fidelity and Schwab is they are going to help the stability of those companies at the end of the 6 months. But let's face it, there's probably a lot of people that want to sell at that 6-month period also, which can drive down the price at that point of execution. What are your thoughts on the group of companies that we've been talking about? What do you think they look like if they IPO and we have to hold them for that 6-month period?
Reddit's a good example. We transacted $29 a share. It was $5 billion enterprise value in October 2023. Company goes public in March 24. Stock trades to $100 a share or something post IPO. We were in at the cost basis of $29 a share, so we're feeling pretty good about the thesis playing out on that investment. We're locked up for 6 months. Pre-IPO investors subject to a 6-month lockup agreement. That's not specific to Destiny or First Trust. That's any pre-IPO investor. Yeah, all insiders. We're locked up for 6 months watching the stock. As the 6-month period approaches, like, you start seeing some selling pressure, like, coming out of the lock, where the stock falls to $55 a share, all the way down. I think $55 a share is maybe where it bottomed. It's why it's so important to distribute the stock to the investors after the 6-month lockup period, because sometimes you can get some selling pressure and depressed stock prices around the lockup period expiring, simply due to, like, a lot of insiders exiting the position when the lock burns off. Now the stock's trading at, it's $220 a share. I mean, it pretty quickly rebounded to $200 a share.
Dude.
And a lot of the clients held on to the position. I would say the majority of them held on to the position because we gave them the stock in kind, rather than said, okay, we're going to blow out of the position after 6 months at $55 a share. We still made a 2x on the investment. Here's your cash distribution of long-term capital gains. So you want to think about being prudent around one of the small
It would have been
things.
short-term capital gains.
It would have been, probably
Yeah.
inside, a little bit inside and short terms. It's another thing. Typically, these are going to be more than 1 year holds, but that was a really quick one. So I think we're excited about the IPO and potential there in the next 6 to 9 months and how the stock will be received in public markets. The precedents look pretty good and the companies are really performing. And so I think you're at this perfect storm of strong fundamental performance and probably some benefit in terms of macro environment or timing
For sure.
around these IPOs. And hopefully that bodes well. At the same time, the last comment is, we don't bank on the stock. Everyone has a pie in the sky. Not everyone, but a lot of people have a pie in the sky kind of scenario of, oh, I'm going to invest in this company pre-IPO and I'm going to get this massive pop post-IPO and I'm going to make a ton of money on the investment because it's going to, I think we've done a really good job collectively of coming in at big discounts to IPO price and valuation, where we don't actually need the stock to trade that well post-IPO to have a really good outcome.
No, we're definitely in a fortunate situation with kind of our pool of investments from a standpoint of entry valuation versus current. And to your point, it'd be great for it to IPO and the IPO do extremely successful over the next 6 months and have an opportunity to have it grow that much more in value. But even if it stays at the pre-IPO price where the valuation is right now, it's still a very good investment on the majority of the investments that we've made.
That brings us to the end of today's episode. Thank you for tuning in. Be sure to subscribe to Significance of Wealth on Apple Podcasts, Spotify, and anywhere else you get your podcasts so you never miss an episode. You can also follow Tom Ruggie and Destiny Family Office on LinkedIn and Destiny Family Office's website for more insights on wealth management, private market opportunities, and collectibles. Until next time. The expressed views, thoughts, and opinions belong solely to the host and/or guests and are not investment recommendations or opinions issued by Destiny Wealth Partners or its affiliates. Investment advisory services are offered through Destiny Wealth Partners, LLC and SEC, registered investment advisor. Destiny Wealth Partners also conducts business under the name Destiny Family Office. Destiny Family Office podcasts are the sole property of Destiny Family Office, and information provided is for informational and educational purposes only. The funds discussed are typically for qualified purchasers, defined as $5 million of investment net worth, exclusive of primary residence. Learn more at www.destinyfamilyoffice.com/disclosures.